You know, it's kind of amazing when you think about it. For all investors together, trying to beat the stock market, it's a zero-sum game.
Before you even factor in any costs, yeah. One person's gain is another's loss, perfectly balanced.
Exactly. Welcome, everyone, to Book Talk Finance. Today, we're digging into a really foundational book, The Little Book of Common Sense Investing by the late John C. Bogle.
Jack Bogle, a
Yeah,
giant in the field. The book came out in 2007, but its message feels, well, timeless, really.
totally.
Uh,
And for anyone who might not know, Bogle founded Vanguard back in '74.
right, and then launched the very first index mutual fund for individual investors in 75. Just completely changed the game.
He really did. Hugely influential, respected by people like Warren Buffett, even Nobel laureates.
And his core idea in this book, it's surprisingly simple, isn't it?
It is. It boils down to common sense, like the title says. Bogle argues that successful investing isn't about complex strategies.
No, it's about owning basically all of the country's publicly held companies.
Owning the whole haystack, not searching for the needle, and crucially, doing it at a very, very low cost.
So you capture the market's long-term returns, the dividends, the earnings growth, all of it.
Yeah, and the book lays out why this simple approach works so well. He starts with this great story, the parable of the Gotraka family.
Oh yeah, the Godracks. It's a really effective way to illustrate the core problem Bogle sees in the investment world.
So picture this family, the Gotraks. They own like 100% of corporate America, all the stocks.
So initially, they get 100% of the returns, all the profits, all the dividends, simple.
Right. But then along come the helpers, financial advisors, money managers, brokers.
The intermediaries. And they all want to, well, help the Gotrocks manage their money.
Mhm.
For a fee, of course.
Exactly. And they start trading, picking stocks, trying to beat the market for the family.
And what happens to the family's share of the total return?
It shrinks significantly
Yeah.
because all that activity, all those fees paid to the helpers, it comes directly out of the Gotraks returns.
Even if some helpers do well temporarily, the costs for the family as a whole mean they end up with less than if they just held on to everything themselves.
It perfectly illustrates that Warren Buffett quote Bogle uses. For investors as a whole, returns decrease as motion increases.
More activity, more costs, lower net returns for the group.
And Bogle adds his own crucial point, the conflict of interest. The investment business often thrives on activity, right?
Absolutely. The mantra is often, don't just stand there, do something. Buy this, sell that.
But for the investor, especially the long-term investor, Bogle says the best advice is often the exact opposite.
Don't do something, just stand there. Let the market work for you. Minimize the friction.
It's a really fundamental point. The incentives aren't always aligned.
Not always. Okay, so that sets the stage. Then Bogle really dives into the power of compounding returns.
Oh, yeah, the magic of compounding. He shows what happens with just $1 invested at, say, 9.5% a year, which was roughly the historical return on corporate capital.
And over time, it's just
Great.
incredible.
It really is. After 10 years, that dollar becomes $2.48. Okay, nice. But wait 50 years.
It explodes, doesn't
Yeah,
it?
it grows to $93.48 from a single dollar. That's compounding working for you.
But then comes the flip side, the tyranny of compounding costs.
Exactly. That same compounding force works against you with costs. Management fees, fund expenses, trading costs, taxes, they all compound too.
And they steadily eat away at that potential return. It's relentless.
He gives this example, right? The S&P 500 might return, say, 12% a year over 25 years, a fantastic return.
Fantastic. But the typical investor in funds tracking it, or trying to beat it, didn't get 12%.
No, they got less than 10%. That gap, maybe 2% or a bit more each year.
Doesn't sound like much, 2%.
Yeah.
But compounded over 25 years.
It means losing over 20% of the market's total return. Just gone to costs.
It's what Bogle calls the relentless rules of humble arithmetic. As a group, we investors get the market return before costs.
Then costs subtract from that. So trying to beat the market as a group becomes a negative-sum game after costs.
Which leads directly to his solution, the index fund.
Right. Let's clarify what he means by a classic index fund. It's not just any fund that tracks an index.
No, the classic Bogle-style index fund is super broad. It holds basically the entire U.S. stock market.
Thousands of stocks weighted by their market capitalization. So it mirrors the overall market.
And crucially, it does this with rock-bottom expenses. No high-paid manager trying to pick stocks.
Minimal trading too, right? Just buying and holding. which means very low turnover costs.
And high tax efficiency, because you're not constantly realizing capital gains.
So it's designed to just capture the market's return minus tiny, tiny costs.
Almost the entire return from dividends and earnings growth over the long haul. He often uses the Wilshire 5000 as the benchmark.
Yeah, the total stock market index. It includes the S&P 500, but also thousands of smaller stocks.
Though historically, the returns of the S&P 500 and the total stock market index have been very, very similar.
Pretty much identical over long periods, yeah. From like 1928 to 2006, the difference was negligible.
So owning the market is the winner's game. Trying to beat it. That's the loser's game, statistically speaking, because of costs.
Okay, so if index funds are so logical, why do most investors, or at least actively managed funds, tend to underperform? We've hit on costs, but let's break that down more.
Well, yeah, costs are the big, consistent drag. You've got the obvious ones, management fee or expense ratio.
Right, the percentage the fund charges each year.
Then sometimes sales charges or loads when you buy or sell.
And the less obvious one, portfolio turnover costs. The cost of all that buying and selling inside the fund.
Bogle estimated that for a typical fund turning over its portfolio 100% each year, that hidden cost could easily be another 1% annually.
Wow. So add that to the expense ratio.
Yeah.
It adds up fast.
It really does.
Yeah.
And that leads to Bogle's famous line.
We investors as a group get precisely what we don't pay for.
So if we pay nothing, we get everything.
Yeah.
Meaning the less you give away in costs, the more of the market's return you keep.
He shows this powerfully. Imagine the market gives you 8% a year over, say, 50 years.
Okay, a solid long-term return.
But if your total costs, fees, turnover, everything add up to 2.5% per year,
Which isn't uncommon for active funds.
your net return drops to just 5.5%. Again, 2.5% might not seem world-ending year to year.
But over 50 years, the difference in wealth accumulation it's devastating.
Staggering. You end up with only about 31% less than a third of the wealth you would have had if you just captured the market's full 8% return.
Just shows the tyranny of those compounding costs. And it's not just the fund costs themselves, right? Investor behavior plays a huge role, too.
Oh, absolutely. We shoot ourselves in the foot, trying to time the market, for example.
Buying high because everyone's excited, selling low when panic sets in. Classic mistakes.
And chasing performance, piling into the fund that did great last year.
Which is often the worst time to buy it, as performance tends to revert to the mean. Things even out.
Bogle cites data, I think it was 1980 to 2005. The average fund earned 10% a year.
Very decent.
But the average investor in those same funds, they only earned 7.3%.
Wow. So investors manage to underperform their own funds by almost 3% a year, just through bad timing and chasing hot dots.
Yeah, it's that behavioral gap. Plus, as you mentioned, taxes. Active funds with high turnover.
They're constantly spitting out taxable capital gains distributions if you hold them in a regular brokerage account.
Which lowers your real after-tax return even further compared to a tax-efficient index fund.
Okay, so costs are bad, behavior is bad. But what about just picking the good active funds? The winners. Surely some managers can outperform consistently.
The eternal hope. Bogle looks hard at this. Can you reliably pick winners based on past performance?
The evidence he presents is, well, not encouraging for that strategy.
Not at all. He found that from 1970 to 2005, a long stretch, only about 1 in 14 equity funds actually managed to beat the market by more than 1% per year consistently.
1 in 14. Those are terrible odds.
Terrible. And even looking at things like Morningstar star ratings, people love those 5-star funds.
Yeah, it seems like a good shortcut, right? Pick the 5-star funds.
But Mark Holbert did an analysis Bogle cites. A portfolio of just the 5-star funds, constantly updated.
How did it do?
It actually underperformed the total stock market index from 1994 to 2004, and it took on more risk.
So chasing stars didn't work either. It often reflects past, short-term success, not future potential.
Exactly. Think about the dot-com boom. Those new economy funds were the absolute superstars in 97, 98, 99.
Oh yeah, unbelievable returns. Everyone wanted in.
And then, from 2000 to 2002, they crashed and burned. Utterly disastrous performance.
The first shall be last, as Bogle puts it. Performance extremes rarely last.
So if past performance isn't a reliable guide, what is?
We keep coming back to it, don't we? Costs.
Costs. Bogle shows data 1995 to 2005, comparing funds based purely on their expense ratios. Quartiles from lowest cost to highest cost.
And the results.
Crystal clear. The lowest cost quartile of funds consistently delivered higher net returns.
Not just higher raw returns, but better risk-adjusted returns too.
Yes. Compared to the highest cost quartile, it wasn't even close. Low cost was the best predictor of better future relative performance.
It makes perfect sense. Future market returns are uncertain. Future fund manager skill is uncertain.
But future costs, they're known, they're definite, they're a guaranteed drag on whatever return the market delivers.
So the most logical thing you can control is minimizing that drag.
Precisely. Focus on what you can control, which means choosing the lowest cost options, especially those broad market index funds. Vanguard, Schwab, Fidelity, they offer total market index funds with expense ratios now down to like 0.07%, even lower sometimes.
Practically free, with minimal turnover costs on top of that.
It's the most common sense approach, just like the book title says. Keep it simple, keep it cheap, own the market.
Let compounding work for you, not against you. Avoid the tyranny of costs and the temptation to chase performance or time the market.
So wrapping up our talk on the Little Book of Common Sense Investing, the main takeaway really is about embracing that simplicity.
Yeah, use low-cost, broad market index funds. Capture your fair share of what the market gives over the long term.
And avoid the pitfalls, the high costs of active management, the often futile chase for the next hot fund, the behavioral mistakes.
It's about playing the winner's game, owning the market cheaply, instead of the loser's game of trying to outsmart it after costs.
Well put. Thanks for tuning in to this book talk, Philenians. Definitely subscribe to the channel if you haven't already. We'll have more talks on crucial financial ideas coming up.